Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Jim Smigiel, Chief Investment Officer of Nasdaq-listed SEI. We're here to discuss why, in this particular market environment, diversification is as important as ever. Jim, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
And before we get into diversification, I want your thoughts on the macro environment here. Do you expect continued volatility in the banking sector?
For sure. I mean, I think there's a lot of unanswered questions. Unfortunately, Treasury Secretary Yellen kind of added a little bit of the fuel to the fire with not really being as direct as maybe she could have been in terms of what does all of this mean for depositors in regional banks all around the country. We've seen the broader financial sector be kind of caught up into this mix, and the market is going to be testing weaker hands, and that's what we've seen thus far. A few names in the headlines. I wouldn't surprise us to have that kind of continue until maybe some things can either settle down, or maybe there can be a little bit more clarity from Secretary Yellen.
Right, and of course everyone asks, is this similar to 2008, and how could the current banking situation impact the broader economy?
Well, firstly, on 2008, we don't think it is. So that's the good news here. The good news is this isn't a credit crunch. This isn't 2008 all about mortgage securities, really everywhere on every bank balance sheet. This is very, very different, right? This is really a duration mismatch between assets, liabilities. We don't see this spreading beyond a few kind of weaker players with kind of concentrated client bases. However, that said, will this have an effect on the broader economy? I don't think there's any doubt about that. We're already seeing kind of credit contract. We honestly think this has completely taken a Fed rate hike off the table completely. So the terminal rate of Fed funds absolutely is going to be, there's going to be a lower rate than there would have been if we didn't have this situation, for sure.
So, and of course we have the big banks that kick off earnings next week.
Next week.
What are you going to be listening for there?
Well, we're going to the loan book is going to be really interesting. Earnings in general will be very, very interesting. It's the first foray for a broader earnings season as well. So definitely there's going to be a lot of more focus on the banks. It may be a little bit too early, quite frankly, to see how this is really playing out in quarterly earnings. It did happen last month of the year, really not until the last 3 weeks. But this is going to be the bellwether. It'll be the bellwether for our earnings estimates in general, just too rosy. Even though they've come down, have they come down enough?
Do you see any opportunities in the banking sector? Because you know these things all trade together when you get systemic risk issues or worries. That's
exactly right. Banking sector, even broader financials, consumer finance, capital market names that have kind of been in the headlines. There's a lot of the kind of baby out with the bathwater, and there always is in situations like this. Active management, this is what active managers are supposed to be doing. This is where they should hopefully show their mettle and show their benefit to the end client and find those names in what is kind of a bit of a chaos. So you had mentioned you don't think the Fed's going to do anything in May. Do you see a broader policy shift? Interestingly, we actually think another 25, and then that's it. Mm-hmm. So that's less than a coin flip now. So as of this morning, that's about a 40% probability being priced in that we're even going to get another hike. It won't surprise us, just given some of the rhetoric and the talking heads, including Bullard out this morning. We see another 25 in May, and then we see the pause. And that's the biggest difference, which the market right now is looking for a pivot. We don't see a pivot. I don't see 3 rate cuts between now and the end of the year, between 3 and 4 really being priced in. We think the Fed needs to pause. They need to wait and see what the full effect of all the work that they did in 2022, what does that mean for employment? What does that mean for inflation? What does that mean for the broader economy? I mean, I would be highly surprised if they were to do 3, 4 rate cuts. They do not want to make the mistake that happened in the late 70s and 80s with too quick of a policy shift. That is exactly right. I think they're historians. They know what happened. Everyone is focused on that prior time period. That was the last time that we had inflation at this level. They know that the Fed back then started taking their foot off of the brake too soon, and we had a reacceleration in inflation. They're not going to want to repeat that mistake. They're going to pause, but they're not going to pivot. So we have volatility in the equity market. We've seen wild swings in the bond market. Wild's a nice way to put it. And no one knows what's going to happen with the Fed. Yep. Why is diversification key? Well, that's exactly right. It's because of all of those things and all of the unknowns, right? We're all in the prediction business at the end of the day, and that's a terrible business. No one has a crystal ball. We have no idea what's going to happen. And staying diversified is really and truly the only way to protect yourself. I also think about
your time frame is really what counts.
Yeah.
Like, you want to stay invested if you're a long-term investor. You don't want to miss the opportunities of some of the volatility in the market. And I think it's important to remind investors of that.
I think you're exactly right. I think it's easy for investors to get caught up into what should I do now, what should I do today, what's the next kind of tactical play. It's probably the wrong approach for that end investor. They should have a longer term time horizon, ride out these waves. Diversification allows you to do that. Admittedly, I'm going to talk my book and say active management will allow you to do that. We're active managers. We do think that makes sense, particularly in an environment like this.
All right, Jim, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.